Welcome to Trading an Edge, the podcast where we break down the psychology, mindset, and system of elite trading. Today, we're doing a deep dive into something, well, really vital. We're talking about taking trading, which for many is stressful, maybe inconsistent, and unpacking the framework to turn it into a proper, sustainable business.
Yeah, our mission here is to show you how adopting that structured business mindset can really transform those random, often emotional outcomes into something consistent, sustainable profitability. And let's just kick off with a disruptive truth right out of the gate. Most traders fail. And look, it's usually not because the markets are just too hard. It's because they fundamentally misunderstand what they're doing. They treat it like a gamble, like a trip to Vegas.
Instead of a serious business. Yeah. They wake up, check some headlines, maybe see a chart moving, and just, well, throw some money at it, hoping for the best.
Exactly, hoping for luck.
But what's really fascinating and maybe a bit clinical sounding is that success here isn't about luck at all. It's about structure, objective structure.
Success really demands that business mindset. We're talking structured plans, disciplined processes, meticulous tracking, and this is crucial. Data-driven adjustments.
Data-driven, not emotion-driven.
Precisely. You have to treat every single trade like an operational decision within that business, not some emotional bet you're making.
So accountability is key then?
Absolutely. Enforcing rigorous accountability, primarily through things like detailed journaling and honest performance analysis. That structure, that framework, that's the bedrock. It protects your capital, and just as importantly, it protects your psychology.
Okay, so let's really unpack that, this foundational conceptual shift. Because you're right, the moment you stop seeing trading as just a hobby, or worse, a slot machine, everything changes. Think about the difference. The casual trader, maybe they wake up, log into their account, see something moving fast.
Yeah, FOMO kicks in.
Right, fear of missing out. So they jump in. No defined entry, no clear exit plan, definitely no thought about how much they're risking on that one idea.
And the result? Predictable inconsistency. Maybe some wins, sure, but the losses often wipe them out because there's no system.
So if you want to break that cycle, you really have to embrace this core analogy we talk about. Think of your trading desk, your setup, as the CEO's office.
I like that. You're the operator.
You're the CEO, the founder, the sole operator of this.
Yeah.
Well, it's a highly leveraged startup, isn't it? And every trade you make, that's a serious business decision. It needs to be backed by your plan, by data, not just a whim or a gut feeling. And think about the downstream effects. Skipping your trade reviews, not journaling your results. That's like a CEO completely ignoring their company's P&L statements or cash flow.
You wouldn't run a bakery like that.
Exactly. If you don't track what's coming in, what's going out, and why meticulously, well, failure is almost guaranteed because you can't even diagnose what's going wrong, let alone fix it.
You've hit it right there. I mean, think about any successful business, a restaurant, right?
Oh.
They need a framework. They need to understand their product, the food, the menu,
Their customers.
their location, the market environment, their investment, the capital needed for inventory, staff, rent, and critically, their operational plan recipes, service standards, cost control, which is like your strategies and risk management.
So trading's no different then.
Not fundamentally. Without that framework, you're just reacting. You're reacting to market noise, maybe news headlines, maybe some tweet you saw, and that's the very definition of gambling, not operating a business.
Okay, so that transition, moving from just thinking about it as a business to actually acting like one.
Yeah.
That brings us right to step one, doesn't it? Building the foundational blueprint, your trading business plan.
Yes. This is where the rubber meets the road, as they say.
This plan forces you, really forces you, to answer those critical questions up front. What's the scope? What's the structure of this trading enterprise?
And look, it's not just some mission statement you write once and forget about.
Yeah.
This plan, think of it like the constitution for your trading business. Now, it absolutely can and should be a living document. It'll evolve as you gather data and experience. But you must start by operating within a clear, defined framework.
So how do we define it? What are the key parts?
Well, we can break this blueprint down into about 6 critical components, things you really need to hammer out before you even think about placing that first trade under this new structure.
All right, let's walk through them. Component number 1.
First, define your markets to trade. This sounds obvious, but so many new traders get it wrong.
How so?
They try to be everywhere. They're chasing crypto hype one day, then jumping into futures the next, maybe dabbling in Forex, while also trying to watch a dozen stocks.
Spreading themselves too thin.
Exactly. That multi-market confusion just dilutes your focus. It prevents you from ever truly mastering anything. The clinical, business-like approach says, choose one market initially. Stocks, crypto, futures, Forex, pick one.
And really learn it.
Yes. Commit to mastering its specific nuances. Understand its trading hours, its volatility patterns, its participants. If you choose futures, you need to grasp margin, contract sizes, rollovers. That focus lets you build real expertise.
Okay, makes sense. So one market, what's the second component?
Tightly linked. Assets to trade. Even within your chosen market, let's say you picked stocks, you shouldn't just trade any stock that pops up on a scanner.
Right. Need to narrow it down further.
You need to select a small, manageable list of specific core assets. Maybe it's, 5 to 10 highly liquid blue chip stocks, or perhaps just 2 or 3 major Forex pairs.
And the goal is?
To understand them deeply, know their typical behavior, how they react to news, maybe who the big institutional players are in those names. That concentration of focus, again, it's essential for developing an edge.
Got it. Market, then specific assets within it. Component 3.
Third is capital allocation. Critically important. Define your starting capital. And this needs to be based strictly on money you are genuinely comfortable losing.
Meaning not rent money.
Absolutely not. This has to be risk capital, money you don't need for essential living expenses. Why? Because starting small, with capital you can afford to lose, drastically reduces the psychological pressure.
Ah, the emotional side again?
Always. If you're terrified of losing the money in your account, you simply cannot execute your plan objectively. Fear takes over. So start smaller than you think you need to.
Okay, capital defined. Which leads, I imagine, straight into the defense mechanism.
Precisely. Component 4, risk management. This is non-negotiable for the business to survive. You must define your fixed risk per trade, and then you must maintain it consistently, period.
And we often hear numbers thrown around, like 1% or 2%.
Yes, and 1% to 2% of your total trading capital per trade is often cited as the clinical standard. It's not arbitrary. Think of it as a survivability metric for the business.
Survivability. Explain that a bit more.
Well, think of that 1% rule as your emotional and financial buffer. If you decide, oh, I'll risk 10% on this trade because I feel really good about it.
Recipe for disaster.
Absolutely. One bad day, maybe 2 or 3 bad trades in a row, and you could wipe out a huge chunk of your capital. That leads to panic, revenge trading.
Yep.
It's a death spiral. But if you risk only 1%,
takes a lot more losses to hurt you significantly.
100 consecutive losses just to wipe out your account. Now, that's unlikely if you have any kind of edge, but it gives you the statistical runway. It gives you the emotional detachment needed to keep executing your plan, even through losing streaks. Consistency in that risk percentage is the bedrock of survival.
Okay, vital. Component 5.
Fifth, define your strategies and playbooks. What's your actual trading approach going to be? You need to identify your trading style. Are you a scalper, in and out in seconds or minutes?
Or a day trader, closing by end of day.
Or a swing trader, holding for days or weeks? Maybe even a position trader, holding for months based on fundamentals. Your chosen style has to align with your time commitment, your personality, your psychological tolerance for risk and holding periods.
So you can't be a scalper if you panic with every tick.
Exactly. And you can't be a position trader if you need constant action. You align the strategy to who you are and the time you can realistically dedicate. Then you define the specific setups, the playbooks within that style.
All right. And the final piece of this blueprint, step 6.
Finally, component 6, time frame and methodology. This is about the how. Decide on the specific tools you'll use. Are you purely looking at price action on the chart?
Candlesticks, support, resistance.
Right. Or are you relying on specific indicators? Maybe moving averages, RSI, VWAP, or perhaps analyzing order flow data. Whatever it is, choose your tools.
And stick with them.
And commit to them. Commit to those specific tools and the chart timeframes you'll use for analysis and execution. The big trap here is constantly switching, trying a new indicator every week, jumping between 5-minute charts and daily charts.
Chasing the holy grail.
You got it. That prevents mastery. If you're consistent with your methodology, then you can actually gather reliable data on what's working and what's not.
Okay, that's a comprehensive blueprint. Market, assets, capital, risk, strategy, methodology. Once that detailed plan is set, we move from planning to doing, right? The operational phase.
Exactly. Now we're on the factory floor. And this brings us to step 2. Track performance through meticulous journaling.
Right, like any business tracking its sales and expenses. But you're saying it's more than just P&L for trading.
Oh, much more. We really stress that effective trading journaling goes way beyond just writing down the entry price, exit price, and the profit or loss. That's the bare minimum.
So what else needs to be in there?
For every single trade, you need to meticulously record the setup. What were the specific market conditions? What was the reason for entry based on your plan? Critically, where did you adhere to your plan, and where, if anywhere, did you deviate?
And the big one, emotions.
Absolutely, your emotions. Before the trade, during the trade, after the trade, were you feeling anxious, overconfident after a few wins? Were you chasing because you missed an earlier move? Were you feeling impatient?
Why track feelings? Seems a bit soft.
It might seem soft, but it's incredibly powerful data. It keeps you honest. Let's say your journal shows that 90% of the time you follow your plan calmly. You make steady progress. But the few times you felt greedy or maybe revengeful after a loss.
Those are the times you took big hits.
Exactly. Maybe you broke your risk rules, held a loser too long. Now you have objective evidence in your own handwriting or spreadsheet linking specific emotional states to costly mistakes.
So it's not about eliminating emotions, but understanding their impact.
Precisely. This data creates accountability. It stops you from blindly repeating the same expensive psychological errors. You're basically gathering actionable intelligence on yourself, your own biggest variable.
Okay, that makes sense. Gathering actionable intelligence. And that intelligence then feeds directly into step 3, which is...
Review and analyze. You've got the data from your journal. Now you need to process it. You have to treat this like setting mandatory internal business meetings with yourself.
Like a performance review for the CEO, which is me.
Exactly. You need to implement disciplined review sessions, maybe a quick daily recap. What did I do well today? Where did I slip up? Then a more thorough weekly review. How did the P&L curve look? Any patterns emerging?
And longer term.
And definitely detailed monthly, maybe even quarterly recaps, looking at the overall effectiveness of your strategy. Are the stats holding up? Is the edge still there?
What are we looking for in these reviews?
What's genuinely powerful here is the pattern analysis. You stop generalizing like, oh, I had a bad week. You get specific. You analyze objective patterns.
Gotcha.
Identifying the precise times of day or specific market conditions when your strategy performs best or worst. Which specific assets that you trade are giving you the highest win rate or profit factor? Which setups consistently lead to losses even if they fit your rules?
So you can tweak based on hard evidence.
Exactly. This data-driven approach uncovers your objective strengths and weaknesses. It allows for focused, almost surgical improvements to your process, rather than just randomly changing things because you feel bad after a losing streak. It replaces guesswork with evidence.
Right, evidence-based decisions.
Moving on to step 4 then. We've planned, we're tracking, we're reviewing. What's next for running this like a business?
Step 4 is about professionalization through time block learning and discipline. You're the CEO, remember. You need to structure your workday like one.
Meaning not just randomly checking charts all day.
Definitely not. This means time blocking. Dedicating specific, protected hours for the actual trading operation itself when you're focused, alert, and executing your plan.
But also time for the other stuff.
Yes, crucially. Also blocking out time for the non-trading operational necessities. Dedicated time for that meticulous journaling we just talked about. Dedicated time for the weekly and monthly reviews.
And time for continued education and self-awareness. If your strategy relies on understanding sector rotation, you need time blocked for that research. If you need to work on managing impatience, maybe you block time for mindfulness exercises or reviewing your psychological journal entries.
So it's about treating the whole process professionally.
It is. That consistency in time management builds the necessary discipline. It also helps contain trading to its allotted time, preventing it from spilling over and creating stress in other areas of your life. This actually increases focus during those prime trading hours.
And this structure, this discipline, it links back to psychology again, doesn't it?
Directly and deeply. This is rule 4. We talked about the deep psychology connection. When you have a structured process, when you have defined rules and scheduled time for each task, you dramatically reduce the opportunity for making impulsive, emotional decisions.
Fewer chances to just react.
Exactly. Think about what destroys trading accounts faster than almost anything else. Emotional risk-taking, doubling down after a loss, taking way oversized bets on a sure thing.
Or constantly changing strategies.
Yes, that frequent style hopping. Trying a new system every week because the last one had a few losses. Discipline and structured processes act as guardrails. They actively protect you against these destructive emotional behaviors.
So the structure allows for rational evolution.
Precisely. It allows you to deliberately evolve your skills and strategy based on the evidence you're gathering, rather than just reacting blindly to the immediate fear or greed of the moment.
Okay, so we've built the plan, we're tracking the data like crazy, we're managing our time like a pro. But Let's face reality, losing streaks happen, even with the bust plan.
They absolutely do. Probability guarantees it.
So now comes that moment of truth. Maybe I've had 5 losing trades in a row. Every fiber of my being is screaming, this isn't working, change everything. Now, how do we tell the difference? How do we know if an adjustment is truly necessary versus just an emotional panic reaction?
That is perhaps the essential psychological barrier that separates sustainable success from blowing up. This is where we put the data to the ultimate test.
The data test. Okay.
Here's the key. Essential, necessary adjustments never stem from one bad day or even one bad week. They only stem from consistent, statistically significant patterns that you identify over many weeks, or more likely months, through that meticulous data analysis you've been doing.
So I need proof from my journal.
You need documented evidence from your performance journal showing that a specific variable, maybe your entry criteria for a setup, maybe the time of day you're trading, maybe a specific indicator you use is consistently underperforming over a large sample size of trades.
And the changes should be small.
The changes should be incremental, small tweaks based on that evidence, not wholesale changes to the entire business model overnight.
Okay, so that's a necessary adjustment. What does an impulsive one look like?
Impulsive changes are those that arise purely from emotion, reacting to a short-term string of losses, maybe seeing someone else succeeding with a different method, and just ditching your plan without any data backing the shift.
Even if the plan was working before.
Especially then, if your strategy has shown a statistical edge over the last 3 or 6 months, a single bad week is usually just noise, statistical variance. It is not a signal to panic and overhaul the entire business. Resisting that urge is paramount.
That distinction is critical. And it leads right into step 5, doesn't it? Make incremental adjustments.
Exactly. You're adjusting the dials on a machine that's mostly working, not throwing the whole engine out. Any changes have to be deliberate, small, tested, and informed by your data analysis.
Patience is key here then.
Patience is everything. You absolutely must avoid premature shifts based on a small sample size. You have to give your statistical edge enough time, enough trades to actually play out according to probability.
Don't jump ship too early.
Never. Which brings us to the final overarching piece of the puzzle. Step 6. Maintain discipline. You could call this the consistency rule.
Wrapping it all together.
It really is. This trading business requires a long-term perspective. Once you've defined your operational plan, your market, assets, risk, strategy, methodology, you must commit to executing that specific process consistently for a meaningful period.
How long is meaningful?
It varies, but 6 months is often cited as a reasonable minimum time frame. You need enough time, enough trades to gather sufficient statistical data to either validate or potentially invalidate parts of your strategy with confidence.
And that consistency, that's what builds the profitability.
That consistency is the only thing that builds sustainable long-term profitability. It's the ultimate guardrail. It protects your trading business from the internal disorder, the emotional chaos, the fear, the greed that unfortunately kills most traders long before they ever find real success.
So wrapping it up then, the path involves.
To briefly summarize that path we've laid out, first, build a solid, detailed business plan. Focus on mastering one market, specific assets, and a defined strategy. Second, rigorously track and analyze everything, trades, setups, emotions to gather that objective intelligence on yourself and your system.
And third,
enforce disciplined, structured processes. That includes your risk management, your time management for trading, journaling, review, and learning. Do these things, and you start to transform trading from feeling like a lottery ticket into a sustainable, evolving business operation.
a powerful framework. So we'll leave you, the listener, with this final provocation to think about as you move forward. Are your trades random bets driven by hope or fear? Or are they disciplined business decisions executed within a clear framework?
Because success in trading, sustained success, it really isn't about luck.
No, it's a direct result of process, of accountability, and of consistent professional execution. Day in, day out, trading an edge where psychology meets profitability.